So I want to start, Seema, you're in charge of now of $150 billion or so of New York City pension money. Tons and tons in equities, relatively modest allocations to the alternatives world for the time being. Is that going to change, and how quickly, I guess?
Yes, absolutely, it will change. So about 3 or 4 years ago, our allocation to alternatives was about 9%. It's now closer to 13, 14%, and now it's on its way to 20%. So we're still, though, dramatically overweight to public equities. We're still nearly 60% of our assets are in U.S. and non-U.S. long-only equities. The idea is, though, through our asset allocation study that we did for all the 5 boards, all the 5 systems, a couple years ago, the idea is to reduce that allocation and then continue to move into alternatives. And that includes hedge funds, private equity, real estate, infrastructure, and opportunistic fixed income.
Okay, and until you took over as CIO, you were looking after the hedge funds.
I was actually, head of public equities and hedge funds.
Right. So, and you mentioned to me when we were talking about this session that concerns that you had recently on hedge funds or observations about performance, about fees, and one that I thought was interesting, not such a perennial, which is the turnover of talent. Maybe you could talk a little bit about that.
Yeah, I don't know if you guys have noticed it, but it seems like every fund, either that we have in our portfolio or that we're thinking about investing in, there's just been a lot more turnover than I would have expected, particularly at the top. And not necessarily the founder, the investor, the PM, but co-founders and those around them and those that might be head of risk or might be COOs. And even some senior level PMs, I just find they're retiring. And they're retiring, which I understand, you've been in the business a long time, it's not an easy business to be in and last very long and do very well consistently. But they're retiring in their early 50s. And so it concerns me a little bit because particularly on the side of running the portfolio, you just have to worry about succession. You have to worry about consistency of performance. You start thinking about, are you guys too big? So there are a number of things that kind of throw up red flags for me. And I've noticed a lot more of this in the last year and a half. Have
you had to do anything about that in terms of terminating certain managers, going to others, changing arrangements? Yeah,
no, not yet. We haven't done anything as far as terminating managers, but been spending a lot more time with some of these managers who have had some of these things happen. And they're not necessarily bad, it's just, it throws up a red flag and it creates uncertainty, and so we spend a lot of time trying to figure out what's going on internally and what's really at the core of it.
Okay. We maybe come back to the hedge funds a little. One of the things that was interesting to me when we were talking before is the structural constraints you have around the job you have to do. I mean, it's easy to say you run $150 billion, but it's totally not simple what you have to do with it. You have a tight budget, you work out of this amazing building downtown, but it's not fancy inside, right? Yeah. And you've got 5 different boards of trustees for the different funds, and a new manager, I think you said, has to go make presentations to all of them, and so rather than just having one central point. So, how does that make your job harder, or does it in certain cases just mean you have to make, a virtue of that necessity in some ways?
Right. Well, given what Richard just described, which is actually true, you would be amazed that we actually get investments done. So we have to meet each board once a month. So pretty much we're putting together board packages, which you can imagine takes a ton of time. In the meantime, we're supposed to be doing due diligence, which we do a lot of work on, and go present to these boards our recommendations. So we're the investment advisor to all 5, and we're a trustee on 4 out of the 5. So, that's a challenge only because each one of these boards and each group of trustees, they really, while their asset allocation policies are similar enough, they have very different views of the world and very different philosophies on how they want to think about investing the money. And so it just creates, yes, lots of challenges. And you try to, in some cases, get creative with what you can and can't do with some of these systems in terms of how they think. So as an example, Teachers does not invest in hedge funds right now, but NYCers, police, and fire do. Board of Ed does not either, but they're a much smaller fund, and so they have other things that they're focused on in terms of alternatives right now. But you know, instead of focused on hedge funds, Teachers is going to invest in, likely to invest in emerging market debt. We're trying to educate them on that and get them interested in that, and so we'll see what happens. But it's a lot to think about, and it's a lot to do. And yes, our managers have to come to each of these boards and make presentations. And you know, by the 5th meeting, you're like, okay, I've already said this before. You've already said this before. Nice to see you again. So it's not easy. But the thing is, it's really hard to get money from New York City. But once you get our money, it stays with you for a long time. So that's the good thing.
Okay. What kind of things have you been able to do? I mean, we talked a little bit about when, in the recent years, when you came on board, or maybe it was John Liu, or you know, before you came on board, started this process of trying to weed out some of the managers who had been there too long, maybe, and so on. So within these constraints, you've been able to improve things a little bit in recent years, right?
Yes, that's right. I mean, actually, I'm very proud of what we've done in the last 4 years with the portfolio. I mean, it's, as you know, given all these constraints and a lot of different agendas at the table. Oh, and by the way, we have 5 general consultants, 2 private equity consultants, 2 real estate consultants, and a hedge fund consultant. A lot of consultants. So there's a lot of people to get on the same page. But, you know, as an example, we took the public equity portfolio, which is about 85 billion of the 150 now, and we dramatically changed the profile of it such that we've added, I think we've added a couple hundred basis points to our excess return just in that portfolio, which is a big number when you think about it. Where there just were a lot of underperforming managers. We shifted money more into passive indices as opposed to active management in areas of the market, as you know, that are much more efficient. And we went into more inefficient parts of the market. We put more money in emerging markets and developed markets and pulled money out of U.S. equities. So we did a lot there, which, again, the termination part, we terminated 41 managers, and it's not an easy thing to do, again, when you've got a lot of people to get comfortable with that kind of thing. So we did that, and that helped a lot. And then we launched a hedge fund program from scratch. So New York City had never invested in hedge funds before. Larry Schloss, our previous CIO, showed up in January 2010, right after John Liu got elected, and I was his first hire, and I showed up in April of 2010. And so we were able to build a team, which is great. We hired Axia to be our hedge fund consultant. We hired our administrator, Sitco, and then we started making investments after we got an allocation approved of $4 billion, which is great. And we've actually already invested about $3 billion of it in the last 2.5 years. So it's doing what it's supposed to do. I mean, the design around this whole program has been to reduce this public equity market volatility. I mean, we just bounce around too much with the stock market for a large public plan like ours. Not very good for us. So pre-08, we were at 115 billion in assets. Post-08, we went down to 75 billion in assets. It took us 3 years plus to get back. Which is a long time. And so we can't afford that kind of market volatility. So that really is why we launched a hedge fund program and designed it the way we did. We increased our allocation to private equity. We increased our allocation to real estate. We added an allocation to infrastructure. We increased our allocation to opportunistic fixed income. It's all around this kind of philosophy.
So John Liu, who was the controller before your current boss, Scott Stringer, had started floating this idea to create an investment corporation, I guess, investment management corporation for the city. So instead of having these 5 funds and different sets of rules, you have a more centralized process, a little more flexibility, maybe more ability to start managing money in-house rather than outsourcing everything. Is that still an idea with sort of both logic and legs? As far as you see it?
Yeah, so I've been working with our new comptroller, Scott Stringer, for 3 months. He's a really nice guy. He's a good guy. We've been working well together. I do believe that he cares a lot about those issues. I do believe that he's very interested in some kind of reform so that we are more efficient as an investment manager of $150 billion. But it's not easy. I mean, as you can imagine, you have so many people at the table. We have 58 trustees. And they represent big unions in New York City, so it's not an easy thing to try to do. We did try to do it in the last administration. I thought we got pretty far, but not far enough. So it was unfortunate, but it's still something we have to do. I mean, we've had this structure in place in New York City for 75 years. We're the only ones that I know of, particularly of the top 10 plans in the country, of which we're number 5, that were set up like this. And where we have very little discretion from the trustees. So the Bureau of Asset Management, which is where we sit inside the Comptroller's office, we're trying to get more discretion from the boards, and we do have some in some places, in some asset classes, but in certain sized investments. So we're trying to make our way in that direction. We're still talking about trying to consider having 1 board instead of 5. How would you do that? Catherine Bonat's in the audience, who works on our team, and we talk about this all the time. She's been very helpful with trying to figure out how should we think about this, how should we put this thing together. It's a big deal, and it would, I mean, look, we look at the Canadians, and I don't know if anyone is here from any of the Canadian plans, but they're awesome. And we look at their models, and we want to do that, and that a lot of that is bringing money in-house too, to manage. Of the top 10 plans in the country, on average, those folks manage 50% of their money in-house. We manage 0. So all of our money is run externally, and we pay out $400 million a year in fees.
And your budget for your
our payroll
for your 30 people or whatever
for our
it is?
30 people is about $4 million.
Now, after we talked about this a little before, I was looking up the Ontario plan, which is similar size, right? And I pulled these numbers. I may not have read it carefully enough, but it seems like they have 900 people. 900 people working there, and their investment costs are about $300 million. So, if you could take all those fees in-house, you could do the same thing cheaper, maybe.
Yeah, and they also outperform us by 200 to 300 basis points.
Right.
You start adding that up every year. That's billions of dollars every year. That's huge, huge numbers. It's not to say that you can take exactly what they do it here in New York, and you're guaranteed to get 200 basis points of excess return, but even 100 basis points would be great, which I think we could do. And a lot has to do with governance. I mean, you read all these studies about governance and how plans are set up, and not just public plans, but foundations and endowments and how they do things. And we looked at all of these studies, and it's really not surprising to me that if you're set up a certain way, you can make more money. And I just think that we're set up a way that makes it very hard for us to do that. Now, we are doing it, and it's great. We took our trailing 10-year number before we showed up in 2010 from about 3.5%, 3%, to about 7.5%, 3.5 years later. So it's great. We're moving in the right direction, but there's still so much more we can do, we think.
So how many years before you look like the Ontario plan?
20, at least.
Right.
I mean, it'll take a long time.
10 to change
for
the
us to get
structure,
there.
and then 10 to.
Yeah, I mean, we have to think about what would we bring in-house first. And some peers of mine out there who are great, they've been very helpful with walking me through what they went through and how they did it and what they brought in-house first. I mean, everybody's different, and the talent pool's different. But when we just look at our non-U.S. equities and the fees that we pay there, that's like $60 million. And it's not to say we don't have good managers, I think we do, but if you can control your own destiny in a way that, just saves a lot of money too at the same time, I mean, why not try to do it? We have the talent. I mean, we live in New York City. It's talent capital of the world here for finance and investing, and we can't pay people very much money at this point, but we're trying to change that too. And I think we can get it done. It will just take some time.
Okay, let's talk about today's hedge fund portfolio again for a few minutes, and then after a couple more, I'll see if anybody else has any questions from the room here. What do you look for? What are you looking for in your? Let's start with hedge funds, since that's the focus of this session too. But what do you look for in those managers when you do due diligence? What are the characteristics you want to find?
Well, so going back to the way we structured this program, it's designed around reducing volatility, right, to the public equity markets. So it wouldn't be a surprise to you that we're going to have very little long-short equity in our portfolio, and of that we do have will be low net and market neutral type managers. A bulk of our portfolio is going to be in this tactical trading, global macro CTA type strategies. Another big chunk is going to be in event-driven, both equity and credit, and then we have some relative value in the portfolio. So that's kind of the way it's put together and how we've been building it out. So when we started investing, we made our first investment in a fund of funds because, again, back in 2000, late 2010, early 2011, I didn't have a team, really. We had no infrastructure built out. The trustees needed a lot of education around what this is, how this is going to work, what are these strategies, can you help me understand this and that. So it took a little while, but once we got going, we thought a good way to start would be a fund of funds, and then we'll go direct. And so that's what we've done. So we invested in Permal in the beginning, and now we have 10 direct funds. And again, the mix is a little more tilted toward tactical trading right now than we would like, more of the diversifiers. We would have loved to have had more return drivers in the portfolio last year, but we didn't. So that's kind of where our focus is now, is to continue to meet a lot of event-driven managers, both equity and credit-oriented. So that's what we've been doing. And I mean, clearly all the same things I'm sure everybody focuses on, we do too. So it's performance, strength of the team, the organization, how do these guys make money and how do they think about making money consistently? How large can you get for your kind of strategy? The fees, of course, are important, and we fight every day to get fees down. And I always say to our managers, when we get to a certain point in our due diligence, if we're moving, even a little bit more forward, is they have to come to our office before we make that investment, because when it comes time to negotiating fees, they need to understand that we're not fighting just to fight for fees because we live in these beautiful offices and we get paid a lot of money, because we don't, and we live in a dump. So they need to know what we're fighting for, and we're fighting for our beneficiaries. Every basis point matters a lot. And so that's why we do it. And, we have better luck with certain managers than others. I mean, clearly the largest of the large who've been around for 20 plus years and have great track records, it's very hard for us to get better fees than anybody else might get. But, in other cases we can. We're huge. We have big chunks of money to invest. And we're New York City, and lots of people would like to have New York City as one of their clients, it's a great thing. So those are some of the elements.
So do you lean, I'm not sure Wall Street needs your help, but do you lean towards investing with New York-based managers? Is that part of the thinking, or is?
It's not necessarily, no.
Right.
It's very rare that our trustees will ask us where are they based. We tell them sometimes that, hey, by the way, they flew all the way from Geneva to come meet with you, right. So this is a big deal.
Five times.
Yeah, exactly. So please give them some time of yours and ask questions and be engaged, which they do. I mean, but for those who may have experienced some of our board meetings, if you're on the agenda at some certain time, we try really hard to make sure you don't wait too long out there in the room, but our board meetings can go all different directions and things like that. And we've had managers, unfortunately, flown all the way in from Europe, from wherever, and they sit there for 3 hours, and it's just, but they have to come, and they have to meet the trustees, so they do it, we do it. And, we get the investments done. That's the bottom line. That's the most important thing.
Okay, now is there anyone in the room with a question? If you want to yell, and I'll just repeat the gist of it.
Is there any way that New York City in particular, or public pensions in general, can get closer to being more fully funded through their investments?
I guess everybody heard that.
It's, clearly it's the goal, right? Is that if we hit our target rate of return of 7% a year for the next 20 years, we should be able to cover our payments that we need to pay out, our liabilities stream, right, for these benefits. But That's only if the city continues to put in what they put in, their share. So I think in effect we would have to be up double that number for the next 20 years to make sure that we don't put too much more of a burden on, or even the same burden on the city the way it is right now. So you know what, we're all in this together and we're relying on the city to be healthy. And they're certainly one of the partners that we think about being good. So it's not just the managers, it's not just the trustees, it's not just the comptroller's office, it's the city of New York. And so, I mean, that's not only the case for us, it's the case for all the large cities out there and states. I mean, you know the troubles that some of these places are having because of the pension system and the plan and the benefits. But, you know, frankly, you know, those cities have done things on their own that have created a lot of problems too. So, but so far so good. New York City's in good shape for all you New York City residents, taxpayers. And we're trying to make sure you, as taxpayers, because I'm a taxpayer too, in New York City, don't have to put in more money. So it is up to us. We do have to do our jobs, and we do have to hit these rates of return, again, so that we don't put extra burden on the city that we just don't need.
Is there a-
You want to reduce fees, yet you also want to go more to hedge funds, which charge higher fees. So, how do you reconcile that?
Well, look, I mean, it's not all about fees. I mean, we look at net returns, right? And we look at risk-adjusted net returns. So when I'm thinking about making an investment in a hedge fund, you know, with a Sharpe ratio of 2, and I look at a long-only U.S. equity manager who has an information ratio of 0.5, and that's a home run for them, I'm kind of liking it over here, you know, a little bit. So, look, it's our job every day to try to get fees down everywhere, and we do. We work hard at it. But we definitely look at net returns, and that's what we're focused on. And so there are so many hedge funds right now who aren't hitting those targets. And so that's when I have a hard time. That's when I have a problem with these funds. But then there are others that are doing great, and we want to allocate more money to those people. So, you know, it's not just, you can't just isolate that one thing.
Do we have?
You mentioned two things. You mentioned that you look for opportunistic investments, and another two, that your money is sticky. Now, given these are opportunistic investments, they have a limited shelf life. They don't have longevity. So how do you manage your redemptions, given that, you know, the alpha strategies have a long life, don't have a long life really, and your money is sticky? How do you reconcile that?
Well, I mean, I'm not quite sure what you mean. So private equity is very long-term. Real estate's very long-term.
Some of the hedge fund strategies, for example, if you're invested in RMBS, RMBS has been doing well for the last 2 years,
Right,
and it might do well for a year, but it won't do well for the next 10 years.
right. Now,
Given that you're sticky money, how do you manage that exposure so that you're not the last one holding the bag?
right. So that is a different situation. So that's a very niche strategy the way we look at it, and we would look at it on a more shorter term time frame, right? So you got a new issue fund, and we've looked at some of those, and it's going to be a 3-year opportunity. So we'll structure a separate account with those folks, and that'll be our window. They'll draw down that capital as they draw down that capital, and then they'll come back for their next fund, right? And so in those type of situations, we will have either a direct deal, a term sheet kind of deal. You got to hit this hurdle, and you know that kind of thing, and or a separate account, and that'll be it. And that's how we'll think about it. But those are more, you know, to your point about RMBS and CMBS or something like that. Those are more niche strategies, which we will do, and we do. But you know, when you think about our size, we have to put out $500 million a pop, $350 million a piece. It's hard to you know, focus too much on these more niche strategies where we can only invest $100 million. Because you think about it, $100 million spread across even 4 funds. It doesn't even show up. Even if we're up 100%, it's like great, but it doesn't, so we try to balance it, and that's what we do.
More in the room. I have one more. Speaking of strategies that may have a shelf life, which is activist funds and activism, which has obviously performed pretty well.
Right.
The city takes a view on a few situations, right? So, like Apple, for instance, recently the city, Scott Stringer, I guess, made a statement about what he thought about David Einhorn's proposal. I think it was Einhorn, or Icahn. Carl Icahn's, not David, yeah. Carl Icahn's proposal on Apple. And yet I imagine that you have to be careful about activist funds because you don't know what situations they may get involved in, and you may not sort of politically want to be associated with certain of those situations. How is that, as a result, do you have any activist investments? Would you have any?
We did, but we don't anymore in public equities, which was where we had them.
Right.
And mostly really because not the noise that they might have created necessarily, or headline risk or reputational risk for us, which we do have to worry about because we're New York City. But they just weren't activist funds in the way that Carl Icahn is, in the way Bill Ackman is, where they'll own 30% of a business.
Right.
Then you have a seat at the table. A lot of the folks that we had money historically with, would own 1% of a large cap company and try to make some changes on the board and stuff. And I just thought, we're paying you really a lot of money for that. I could just buy that stock myself. So we're not in those funds, and most of them were non-US anyway. And look, there are some really great hedge fund activist managers that do really well, and they have great track records. It's just very hard for a fund like us to invest money with them because in many cases, they are very vocal and they're in the newspaper. I mean, one of the things I've said to a group of hedge fund founders in an audience was, look, I know you guys and women have lots of opinions about things, and you feel strongly about certain political things and charter schools and all sorts of stuff. That's great, but why do you have to be in the newspaper about it? Why do you make it hard for us to invest with you guys? So it makes it more challenging,
so it's
for sure.
Problem beyond just activists, actually.
Yeah.
So we're kind of out of time. I'll close with one more question, which the nature of politics and having elected officials as a boss, whatever, is that your job only lasts as long as they do or as long as they want it to. And for now, you're in the CIO job until June. I think that's right. What happens then? I mean, not what's the process? I guess. Might you be the CIO after that? What?
You said you weren't going to ask me that question.
I tried to ask it slightly different. The one I said I wouldn't ask you.
So that's another thing about the way we're set up in New York City. Every 4 years, which it tends to be the case, a new comptroller gets elected. And that comptroller appoints the CIO. So every 4 years, the CIO of New York City turns over. And your senior staff tends to turn over. So anyone who runs an investment organization, how do you run a successful, long-term, consistent investment organization when your CIO turns over every 4 years, and so does a lot of your senior staff? All the institutional knowledge walks out the door, and it's $150 billion. So it's a problem that we need to fix. Now, Scott Stringer, our comptroller, has said, you probably heard he wants to stay for a long time. So great. I really hope he does. And then, the CIO will stay for a long time too, which would be really great for the funds and for everybody and the beneficiaries and the staff. And, yes, I was with the John Lew administration working under Larry Schloss, our CIO. Larry left last October, and when he left, I became interim CIO. And then when Scott Stringer got elected, we had a conversation, and I wanted to keep the great momentum going and the great performance going that we have had, and staff together, and keep the team together, and I just felt like I needed to stay and help and do this, and so I committed to stay for 6 months, which is, I said through our fiscal year end, which is June 30. And in the meantime, I know he wanted to do a nationwide search for CIO, and that would give him time to do that. And, meanwhile, I was always thinking of going back to the private sector, making my way back. And here I am 4 years later. Honestly, I really wanted to do public service. That's why I came. My whole career, as you probably have read, has been in equities. I've been a long-only equity investor, a long-short equity investor, big mutual funds, big hedge funds. Ran my own hedge fund for a while, and I just wanted to do this and do something good for the world. I just felt compelled and very passionate about it. So that's why I came, and that's why I'm still here. So the answer to your question is, I don't know. We'll see. We'll see what happens. But it's been great, and the new administration has been very supportive, and I think the group is very talented, and Scott surrounded himself with some great people. And I really do think he wants to do a lot of great things for the city. So it's all good. So we'll just see.
Great. Well, we're glad you're here too. Thanks very much.
Thank
Seema.
you.